Hey, it's Stuart. I've got a question from Joey. Joey writes, this one might be a bit more complex and might be worth a podcast episode. Perhaps a few listeners also might relate. My parents are just about to retire with minimal financial knowledge and investing throughout their lives. They have around about $1 million of super combined, own their home outright, and have another $500,000 in cash outside super. I've become their de facto advisor for them. They're not listening overly much, but they're asking me about their super during this transition. Question one: how can they manage cash flow and investments during pension phase? For example, if there's a bad year in the stock market, can they ask their super fund to fund the pension from cash rather than selling off shares? And B, are there lifetime income streams that Q Super are trying to sell them a viable product or just ripping them off? They pitch taxation and pension benefits, but it feels like a bit of a free lunch situation to me. So great question, Joey, and sorry that you've become their quasi financial advisor. Although it's great that they can trust you and they're able to have someone that's going to help them. I guess the first question is, how do you fund your super pension? It really comes down to making sure you have the right pre-mixed asset allocation. So you're right. The risk is that the market crashes, and then to fund their pension, they've got to sell in a down market. But of course, the best way to draw a pension would be to take monthly payments. So whilst you'd be selling in a down market, hopefully you're selling in a recovering market as well, unless the market crashes and it just doesn't recover for many years, in which case that's a problem, but probably unlikely. Unfortunately, you can't ask the fund to sell any particular assets because it's a pooled super product. So it's really about, your own asset allocation, or really your parents' asset allocation, of course. If they go too conservative, the challenge then is that they won't be exposed to returns and they will run out of money a lot faster if they don't get the returns that they hope. But of course, if they're too aggressive, they are exposed to volatility, and they will be situations where the market will crash inevitably, as it always does. It'll drop 30%, and then you got to sell in a down market. My advice is to go sort of balanced or conservative balanced, so that you still have some exposure to growth assets. I would say somewhere between 55 to 65% in terms of in growth assets, which is really the share market. I think that's probably most appropriate. That should still expose the portfolio to some returns, but not have too much volatility. But of course, it really depends on their situation and their own risk tolerance and what they're happy with. But really, they should look at the evidence, as I talk about in my podcast a lot. And sure, they need to make friends with. There will be times when markets will crash, and they'll be drawing their monthly pension during that time. But equally, there's times when the market are at all-time peaks, like today, and they're drawing their pension from there. And in the long run, it should level out. And if they're not looking at their super balance every day, hopefully that won't cause too many problems. The second part of your question is, relates to lifetime income streams. And this is something that I don't have a lot of expertise around, to be completely frank with you. But I know these products exist, and I know there are some pretty good tax benefits that they attract in terms of Centrelink benefits. So, of course, in your parent situation, they should probably want to try and maximise their ability to get access to as much of the age pension as possible. I'm not really sure whether they're able to do that given their asset base, but you need to really speak to an advisor that has a specialisation with Centrelink strategies. That's not me, unfortunately. And I wouldn't necessarily, if Q Super is able to offer that advice, that would be good, as in terms of Centrelink strategy advice. And if they've then got a product that sort of helps them implement that advice, that's great. So there are some great benefits there. It's not sort of too good to be true, if you like. but whether they need to access or whether they're able to access those benefits, I think they're probably got too many assets to even get under the asset test, or materially under the asset test in order to get an age pension. So it might not be worthwhile. In terms of annuities and lifetime income streams, so that is that sometimes providers will say you can buy an annuity, which means if you give me $1,000,000, the annuity provider might guarantee to pay you $50,000 a year, irrespective of what happens in the stock market. Now, some people are attracted to that because, great, I take risk off the table. I don't need to worry about the stock market. But in my view, I think they've only got limited application because really, from my perspective, it's more an exercise around education than a product solution. So that is that people just need to be educated that volatility happens. But from point to point, if we're looking over a 10-year period or 15 or 20-year period, they're better off to remain invested and have exposure to risky asset classes or higher risk asset classes like shares. And by being too conservative, it doesn't expose the portfolio to much in terms of returns. And I think that's a bigger risk, right? Rather than making friends with volatility. So I would prefer to then counsel clients through that decision, help them understand that where the risk is, and the risk is underperformance over a long period of time. And that's a greater risk than making friends with volatility. So I don't really like annuities as products. I think if you're so risk adverse, then just go to cash. I don't like them for that reason. But there's a different thing here at play, which is this lifetime income stream and the benefits, the potential Centrelink benefits that provides. As I said, I think your parents probably have too much money and aren't able necessarily to get a large amount of or potentially any of the age pension, in which case then I wouldn't really worry about it. But great question, Joey. I know there's probably lots of people in your circumstance. I'll think about doing a blog or podcast about it, but as I said, it's really not my wheelhouse, and I'd rather leave it to Centrelink experts to be able to provide commentary on these matters. Cheers.